Why do countries borrow money they can never repay? What if national debt isn't a problem to solve, but a system to maintain? The numbers seem impossible. Developing countries owe $8.7 trillion. They've paid $4.2 trillion in interest alone since 1980, yet their debt keeps growing. This isn't failure, it's design. Countries stay trapped in debt on purpose. Not their purpose, but someone else's. The debt serves a function. It transfers power, it maintains control, it enables extraction. Understanding why reveals the hidden architecture of global power. Welcome to Economics of Power. Every country needs dollars. Not because dollars are inherently valuable, because the global system is designed to require them. Oil is priced in dollars, international debt is denominated in dollars, 60% of global foreign reserves are held in dollars. If you want to buy energy, you need dollars. If you want to trade internationally, you need dollars. If you want to avoid economic isolation, you need dollars. This is dollar hegemony, and it creates a structural trap. Countries must either earn dollars through exports or borrow them. Most can't earn enough, so they borrow. This is where the cycle begins. The borrowing starts innocently. A country needs to develop infrastructure, build roads, construct ports, establish electricity grids. The World Bank and IMF offer loans. The terms seem reasonable. Low interest initially, long repayment periods. The country accepts, the money arrives. But there's a catch. The loans come with conditions. Structural adjustment programs. The country must privatize state enterprises, cut government spending, eliminate subsidies, open markets to foreign competition, deregulate finance. These aren't suggestions, they're requirements. Refuse the conditions, lose the loan. Accept the conditions, lose control of your economy. Here's the mechanism. Structural adjustment forces countries to prioritize exports over domestic consumption. Why? Because exports earn dollars to service debt. The country restructures its entire economy around debt repayment. Agriculture shifts from feeding the population to producing cash crops for export. Bangladesh is the perfect example. IMF and World Bank loans pushed the country into shrimp farming for export. Shrimp revenue grew from $2.9 million in 1973 to $590 million in 2012. Meanwhile, the people who farmed the shrimp became poorer, less free, more dependent. The money flowed to debt service and government officials, not to citizens. The result is predictable. Countries following structural adjustment see debt increase, not decrease. Bangladesh's debt grew from $145 million in 1972 to $95.9 billion in 2022. After 10 structural adjustment programs, the country just agreed to an 11th IMF loan, $4.5 billion, in exchange for more adjustment, more privatization, more austerity, more debt. The system doesn't fail. It succeeds at its actual purpose, which isn't development, it's extraction. For every $1 of aid developing countries receive, they lose $24 in net outflows. The money flows from poor countries to rich ones, continuously, by design. The debt trap has colonial origins. When European empires formally ended colonialism in the 1950s and 60s, they didn't end extraction. They redesigned it. Financial colonialism replaced territorial colonialism. The IMF and World Bank, established at Bretton Woods in 1944, became the enforcement mechanism. Initially, these institutions were supposed to stabilize currencies and promote development. By the 1980s, they had become debt enforcers. The shift happened after Mexico defaulted in 1982. The IMF responded by offering loans with unprecedented conditions. Policy-based lending, they called it. Structural adjustment in practice. Mexico became the testing ground. Then the model spread globally. Why do countries accept these terms? Because they're designed to be unavoidable. When a country faces balance of payments crisis, which structural adjustment often causes, only the IMF can provide emergency funding. Private lenders won't touch a country in crisis. Other governments are constrained by the IMF, so countries have one choice: accept IMF conditions or face economic collapse. The IMF even prefers working with dictatorships. Why? Because structural adjustment is politically toxic. It hurts local businesses, it depresses wages, it cuts social services. Democratic governments get voted out for implementing IMF programs. Military regimes don't have that problem. Brazil 1964, Indonesia 1966, Argentina 1966, Philippines 1972. Military coups preceded IMF structural adjustment in each case. The human cost is catastrophic. Studies show IMF structural reforms increase poverty. They raise unemployment. They lower government revenue. They increase costs of basic services. They restructure healthcare, education, and pensions in ways that harm the poor. Countries in or near debt distress now include over two-thirds of low-income nations. More than 3.4 billion people live in countries spending more on debt interest than on health or education. That's not accidental, that's structural. The system is designed to extract resources from the poorest countries to pay creditors and the richest ones. Debt doesn't reduce, it compounds. That's the point. But why do rich countries want poor countries in permanent debt? Control. A country drowning in debt can't pursue independent policy. It can't protect domestic industries. It can't refuse foreign investment. It can't regulate capital flows. It must follow IMF prescriptions or lose access to international finance. This creates a form of sovereignty without independence. Countries have flags, governments, and UN seats, but they don't control their own economic policy. That's dictated by creditors, by the IMF, by the World Bank, by dollar hegemony. Thomas Sankara, president of Burkina Faso, understood this perfectly. He called debt financial slavery and refused to pay. He was assassinated in 1987. Dollar hegemony depends on this system. The United States can run massive deficits because the world needs dollars. Countries hold dollars as reserves. They buy U.S. Treasury bonds. This creates demand for American debt, keeping interest rates low. The U.S. essentially borrows from the rest of the world at cheap rates. Meanwhile, developing countries pay much higher rates to borrow dollars. The interest rate differential transfers wealth from poor to rich countries continuously. The U.S. benefits from what economists call exorbitant privilege, the ability to print the world's reserve currency and have other countries fund American consumption. This only works if other countries need dollars, which requires them to have dollar-denominated debt. The system is self-reinforcing. Developing countries need dollars to service existing debt. To get dollars, they must export. To export, they must follow structural adjustment, which creates more debt, which requires more dollars, which demands more exports. The cycle never ends. It's not designed to end. Countries like India, Philippines, and Congo now owe their former colonial masters 189 times more than they owed in 1970. They've paid $4.2 trillion in interest since 1980, yet their debt has grown from $46 billion to $8.7 trillion. The debt trap that economist Cheryl Payer documented in 1974 has become infinitely worse, exactly as designed. Recent geopolitics reveals the weapon. When Russia invaded Ukraine, the U.S. froze Russian dollar reserves. Suddenly, dollar assets weren't safe stores of value. They were geopolitical leverage. Countries holding dollars realized those assets could be confiscated for political reasons. This weaponization of finance is accelerating de-dollarization. China, Russia, BRICS nations are building alternative payment systems, trading in yuan, rubles, other currencies, creating institutions that don't require dollars. The dollar's share of global reserves has declined from 70% to just under 60%. This threatens American power, which is why the U.S. aggressively defends dollar hegemony, because losing it means losing the ability to run unlimited deficits, and losing the global debt system that funnels wealth to America. Countries stay in debt on purpose because the system is designed to keep them there. The debt isn't a bug, it's the feature. It maintains a global hierarchy where rich countries extract value from poor ones through financial mechanisms instead of colonial armies. The IMF and World Bank aren't development institutions. They're enforcement mechanisms for creditor interests. Structural adjustment doesn't promote growth. It ensures debt service takes priority over human welfare. Dollar hegemony doesn't benefit the global economy. It benefits the United States at everyone else's expense. The debt trap is neither accidental nor temporary. It's the architecture of modern empire, and it works exactly as intended.